Hi, this is TJ. Welcome to the Counterpunch Express training. This video training is designed to get you up and running as quickly as possible. The Counterpunch has been out for quite some time now, and it has proven itself to be a very effective and profitable strategy for all of those who commit to learning it well and to trade it in the manner in which it's intended to be traded. During this training, I will not only teach you the nuts and bolts of the Counterpunch Express, but also how you should use it for ongoing success. This strategy is a way to get started with the Counterpunch trader at a lower entry price and a streamlined approach. The Counterpunch Express, or CPX for short, does not compromise on effectiveness. We have worked hard to streamline the strategy so that we can offer it at a lower price, make it easier to learn, while also maintaining its effectiveness. At some point, many of you will wish to advance to the full Counterpunch trader, while others will be quite content to just stay with the CPX. Either way is fine. The CPX is designed for success, and for those that do decide to advance, everything you learn with the CPX will make for an easy transition to the full-fledged toolset of the CPT, the Counterpunch Trader. Either way, you're in a good position to trade for success with the Counterpunch Express. I've organized these videos so that you can learn the strategy in a step-by-step fashion. So without further ado, let's just jump right in and get started. Let's begin by discussing the basic principles of the strategy so that we can begin to better understand its overall philosophy and what it is trying to do. It's all about price action. I've selected a chart of any old market. I've deliberately hidden the symbol, the price points. I don't want you to be concerned with what this market is, because it really doesn't matter. It doesn't matter what time frame, it doesn't matter what market. What you should see on this chart are price bars. Some of them going up, some of them going down, buyers, sellers. That's what makes a market, and that's what moves the price. So it doesn't matter what it is. But what do you see? Can you tell what is going to happen next at the right edge of the chart? The CPX has several key principles, and if you stick to them, you will stay within the spirit of the strategy and be on the road to trading success. The first principle is being able to identify and take advantage of market exhaustion points. When we look back on this chart, it's easy to see what has already happened. If we could identify that the market's going to turn right at this level here, or if it's going to come back and set up another leg down right at this level, or here, or here. We can go all the way back, and all you have to do is find the pivot points, the swing levels, whatever you want to call them. Not every one is as significant as the other. Okay, so we have to layer in some additional rules that help choose the best setups for us to trade off of. But all these areas are where the market has become exhausted. Okay, think of Muhammad Ali. You've heard me use this metaphor. Rope-a-doping against the ropes. As soon as his opponent's tired, he opens up and comes out swinging. So when the buyers get tired going up, if you knew that in advance, you could come out swinging to the downside, right? Selling short. But how do you know when that's going to happen? For example, at the right edge of the chart, it looks like maybe the sellers are tired here. A moment ago, the buyers were tired. So we have to understand a little bit more about what's happening before we can make trade decisions. Once we put our exhaustion dots on the chart, we can easily see the areas on the chart where the price action has become exhausted, where either the buyers or the sellers have exhausted themselves. Some of those areas are more significant than others. When you see a market making lower highs and lower lows all the way down, you know the sellers are in charge. And every time the price tries to get higher and can't, it sets up for a continuation trade to the downside. But at some point, there's just no more energy on the selling side, and you get a larger exhaustion level. And that's where we want to start taking long trades. Okay, so we have different setups that take advantage of these two different types of exhaustion levels. The stronger exhaustion level, and the smaller temporary exhaustion level. These exhaustion dots are built into the Counterpunch Express calculator, which is a very powerful proprietary indicator that's going to take all these principles, tie it together, and produce trades for us right on the chart. I'm going to teach you that calculator, but first I want to talk to you about the next indicator, the signal line. This is the same indicator that comes with the full Counterpunch Trader, and it is very powerful. It's a very simple principle. It's like a line in the sand that's moving bar after bar, tracking the balance point between buyers and sellers. So when the price bars are closing above the momentum line, the buyers are in control. When the buyers become exhausted, you'll notice that the price will then swing past the balance point and the sellers take over. So when the price is below the momentum line, we're interested in going short. When the price is above the momentum line, we're interested in going long. Sometimes you're going to get this ultra balance, this period in the market where buyers and sellers are evenly matched, and that typically results in choppy price action, indecisiveness, consolidation. And so we have to have ways to mitigate that and avoid getting into many of the trades that result inside of those kind of price patterns. Now, while we would all love to have 100% perfection and avoid all choppy price action and avoid all losing trades, that just does not exist in the world of trading. It's not possible. Nobody knows what's going to happen next on the right side of the chart. And that is not the way to success, because if you continually try to avoid losing trades and avoid all choppy price action, you end up avoiding the winners as well. There's no way to have your cake and eat it too. But what we can do is stack the odds in our favor so that we eliminate most of the losing trades, most of the bad setups inside of choppy price action, and take advantage of most of the good trades and most of the winning trades. Like this, we put the odds in our favor, and then it's just up to us as smart traders to put on the proper size position per our capital. We'll talk about that later. And to manage the trade according to the trade plan. Money is made by the result of the trade plan. And inside of that trade plan are a lot of trades, winners and losers. But because we put the odds on our side, more winners and less losers. That's the pathway to success, no matter what strategy you use. And the way we figured out the Counterpunch Express, we're going to put all the pieces together so that the odds are on your side. So what's the next important ingredient? The HTChop indicator. Now, if you've seen my demos, you would know already that this indicator does a few things for us. The dots on the zero line indicate areas where the market is compressed and choppy. Okay, it's not going to identify every single choppy area. Okay, it's doing it based on a particular set of rules and criteria. The histogram and these two lines are showing us what's happening on a higher time frame chart, the fast trend on a higher time frame chart. As I've spoken of many times, with trend analysis, we have long-term trends, intermediate trends, and short-term trends. But if you look at the short-term trend on a higher time frame chart, that is a chart that's 5 times slower than whatever chart you're looking at, you're looking at the fast trend on the slower chart, but you don't have to look at the other chart. That causes people a lot of difficulty when you have to take your eye off the ball and look at a different ball. That's why we designed this indicator, so that you could have all that information right in front of you, lined up bar after bar after bar. And we're going to use this information particularly for one setup, and that's the Counterpunch setup. And I'll teach you the setups shortly. But we could also use it as a visual cue to let us know where we're at in the cycle. For example, when the cyan line is crossing over the yellow line and the histogram starts moving lower, that's an indication that the market has gotten tired going up and is now beginning to trend down. And when the spread between the cyan line and the yellow line is separating and spreading apart, that's indicating energy towards the downside and more power. And as it crosses down and crosses the zero line, maybe you're about halfway finished with that trend. Now, it's not a perfect idea because nothing's perfect in trading, but notice how when it comes down all the way, it's still trending down, down, down. Clearly in a downtrend, not necessarily because this is red. It's the direction that the histogram is moving from high to low. And when it gets exhausted, the cyan line crosses back over and it starts moving up again. And that's corresponding with our exhaustion dots and our momentum line. So there's a lot of information on this chart for us. What happens when you're kind of going sideways? Well, maybe we're getting to a point where we could be going into some consolidation. Who knows? So we need rules that tell us when to take trades. Coming up shortly, I'm going to teach you about each setup and teach you the rules of the setup and what actually makes each trade. How we develop the targets, the stop, the entry. But there are two more indicators that we add to our chart to assist us further. And these are just exponential moving averages. And they're obvious moving averages. This is a 50 moving average, this mustard colored line. And this line here, this magenta line, is a 200 moving average. And I've darkened them. These lines you could put on your chart very bright if you want, but I have darkened them because I don't want them to have too much power in influencing my trade setups. Okay, they're just additional tools that help us in certain situations. And I'm going to explain that as I explain the trade setups. And they're also optional. You don't even have to use them. I like to use them. One thing that's very helpful is just to scroll through your charts and notice how the price action cycles around the EMAs and what happens with the 50 cycling around the 200. And so as you continue to scroll through your charts, you'll notice that there are times when it is coming down and then it crosses over. Sometimes it crosses over with more velocity, goes further, faster. Other times it just kind of stays close to that 200. These areas inside this move down where it tightens and squeezes, we call that the squeeze zone. And there are times when we're not going to take trades in a certain direction if they set up inside of the squeeze zone. And I'm going to explain that to you later. But it helps to just put these on the chart without the calculator and continue to notice how it behaves. You're going to start to see similar patterns over and over and over again. And it's very useful. If you knew not to go short here and to only get into a long position, you'd be in a great position for a big move higher. Another thing I want you to notice is when the price moves further and further away from the 50 EMA, ultimately it wants to get back to it. And it's either going to move back to it or it's just going to move and pause while the 50 catches up to it. And it eventually makes its way back to the 200 as well. And so you're going to notice that when it's in the middle of this area, sometimes it's going to find support, get exhausted and go the other way. Sometimes it's going to bounce around in between before it ultimately decides, but it's going to repeat. There's only a few things that are going to happen, and it's going to happen over and over and over again. So if we're astute and we pay attention, we can notice these things and take advantage of this continually repetitive price phenomenon with these lines. All right, I'm going to start to teach you the trade setups next. The Counterpunch Express is going to take advantage of the 4 specific types of trades that produce the most profits: reversals, trending trades, continuation trades, and breakouts. We have 3 setups, and the combination of these 3 setups take advantage of all 4 of those types of situations that we can profit from. All 3 setups are based on the principle of market exhaustion. Also, additional confirmation. And that's what the momentum line gives us. That's what the high trend chop indicator gives us. And finally, price action itself. Price action is king. The direction of price action ultimately is going to decide if we're going to get into a trade or not. And because this strategy is based on pure price action, it's always going to work as long as you're trading it on a market that's moving with rules to a proven trade plan. We'll talk about trade plans later. So let's learn about these setups next. The first setup I'm going to teach you is the counterpunch setup. That's what we call it. And it's always going to show up in white. It's going to take advantage of the biggest and most tired situations in the market, the biggest exhaustion points. So you'll see, looking from left to right, that you have a short here. Doesn't go very far before it turns around and goes the other way. You have a setup here, but notice that the price never moves down far enough to trigger into the trade. How do I know that? Because this little plus sign here is your entry point. Up here is another trade setup, and notice that it gets you short. The price is below the momentum line. It triggers in, and it moves down, hitting some targets. And then finally, the market gets super tired on the short side and goes up for a nice long trade. This is the counterpunch setup. It's designed to give you the big reversal setup, but sometimes it'll give you breakout trades out of consolidation. It could do that as well. So let's talk about how it works. First of all, it's all based on the exhaustion dots here. When you have a group of 3 dots, in this case, these would be long exhaustion dots, right? Because the market gets tired going down, and so we're looking to take a long trade. You need a group of 3 dots that's lower than 2 groups to the left, the very immediate 2 groups, okay? The first group to the left and the second group to the left. When that happens, you could start to look for a possible counterpunch setup. Okay, and it's very important that you understand that you have to have the immediate 2 groups to the left. The first one to the left and the second one to the left. It has to be lower. Okay? For the short trade, you have to have 2 groups of the left. You have to have 2 groups of dots to the left that are lower. This group is lower, right? And this group is lower. The first one to the left is lower. The second one to the left is lower. Okay, that's criteria number 1. Secondly, the high trend has to go, if for a long trade, the histogram has to be in the red, and then the cyan line crosses over the yellow line and closes on the other side of the yellow line. So when we look at this setup here, you'll notice that that happened. The next thing that has to happen is at the moment of the 3rd dot, or a certain amount of bars past the 3rd dot. Normally, we'll look up to 4 bars to the right, but it could be less, it could be more, depending on the trade plan. But you have to have a bar that closes on the other side of the momentum line and closes green. Okay? Now, if it happens to be a doji, like let's say this bar is the first bar that closes on the other side of the momentum line. It's a doji, right? There's no body. Has a high, a low, but the open and close of the bar is identical. That's called a doji. That also counts. So that would also count as a setup bar. Okay, but notice that we have your 3rd dot, and then the very next bar here is green, and it closes up and over the momentum line. That's what we would call our setup bar. All the conditions are in place. You have your set of exhaustion dots that are positioned the way they need to be for the setup, right? The 2 groups are higher. The 2 groups of dots to the left are higher. The high trend indicator is in the red, and the cyan line crossed over the yellow line. Then you have a green bar, the first green bar, since the dots, closing on the other side of the momentum line. The final piece of confirmation is that the price has to travel a certain distance beyond that bar. It has to break out beyond that bar in order to touch that entry and make it a trade that gets triggered in. So the final piece to this setup is the price action itself continuing to move in the direction of our long trade. Okay, and the same thing happens on the short. Notice that the short setup is a doji, right? You have a little bar here closing on the other side of the momentum line. There's no body to the bar. Now, if this was a green bar closing up, then the first red bar here would be the setup. And like I said, we're going to look X amount of bars to the right. Usually it's 4. Okay, if the trade plan is set to 4, if the 5th bar is the first bar that's red, you're not going to see a setup. Okay? Some trade plans we might look 5 bars over, but usually 4 is as far as we're going to go. In this case, it's the first bar. It's the bar on that third dot. That's okay. Now, the principle of the first bar closing on the other side being green or a doji if we're going long, or being red or a doji if we're going short, that principle is the same with all the setups I'm going to teach you. Every setup is going to basically be the same as this one. However, the additional setups that I teach you use a different kind of confirmation. The counterpunch trade requires the high trend to be turning into the other direction. That's unique to this trade setup. The next setup I teach you doesn't need the high trend because it uses a different kind of confirmation. Now, we could have released this strategy with just the counterpunch setup and nothing else, and you'd have a very effective strategy. Some traders just focus on this one setup alone. They learn how to master it, and those are the only trades they take, and it is very effective. And when I show you how the Counterpunch Express calculator works, the very indicator that is plotting these trades on these charts, I'm going to teach you how you can turn on or off any one of these setups and use any combination of these setups. So let's get into the next setup. The next setup does not require the high trend chop indicator. All the next setup requires is a failed swing level or an exhaustion point that's moving in the direction of our trend. So for example, when the price comes up to try to test this swing level up here, it fails to get high enough, and instead it gets tired and continues down. It comes up again and fails to get above this level. It comes up again and fails to get above that level. And yet here it comes up again and fails to get above this level. And that's what creates the trend, right? And the stair-stepping move down. The next setup we simply call the failed swing level. Or you can simply call it the green trade. And it looks like this. Whoa, there's a lot of setups there, right? Usually, this setup is going to produce a lot more trades. Doesn't mean we're going to take every single one, although some traders do. And on some markets and in some situations, you can certainly use them to build a position and take advantage of a trend. That's pretty advanced. For now, let's just say we're interested in one setup only, the first one, okay? Or the setup that comes next as it relates to the rules of our trade plan. All right? And again, I'm going to teach you how to use these setups later. I just want to show you what these setups are at this point. Each setup requires a certain amount of confirmation from price action. The white trade, the counterpunch trade, requires the high trend to be turning. And the reason why is because you cannot tell if it's going to keep moving in the same direction or if it's going to give us a big exhaustion and reverse in the opposite direction. So we need the higher trend indicator to give us more confirmation. But with the green trade, we don't really need it. We could use this information, but we don't have it built into the rules of the setup. All we need is a group of dots. In this case, because we'd be going short, we only need to be lower than one group to the left, or equal. So when this one comes up, it's equal to one group to the left. Okay, the idea is it failed to pierce through and make a higher swing level. It either made an equal swing level, or like in this case, it came up and made a lower swing level. This level here is lower than this level here. And you can easily see it with the exhaustion dots. Then, of course, just like the counterpunch trade, it's the first red bar that's either on the third dot or up to 4 bars over, and you get a setup. So in this case here, this doesn't meet the criteria, because if you look to the left, it's higher than the group of dots over. This is a counterpunch trade. It used the histogram. But on the next group of dots, it failed to get above this group of dots. It's lower. It's lower than one set of dots to the left. And that's what gives us the green trade, the failed swing level. Okay? It happens again here, and you get another setup. It happens again here, and you get another setup. It happens again here, and you get another setup. And if you look at all 4 of these, each and every one of them is a winning trade. So it's showing you strategic places along this price action where you can take trades. What about long trades? Let's look over here on the left. This group of dots is higher than one group over to the left. And the first green bar to close above, either on the third dot or up to 4 bars over, in this case on the green dot, gives us a long trade. But notice that the price comes up and it doesn't quite touch the entry. In fact, it takes 1, 2, 3. On the 4th bar is when that trade triggers in. And that's okay. That's fine. Now we have rules that will cancel these setups, and I'm going to explain those to you in a moment because they work the same on all the setups. Right now I'm just trying to show you what makes a setup. And notice how that comes up and hits targets. So does this one. This one comes up, even hits target 1. Well, all these trades are winners as well, going up and going down. The green trade is very powerful, and it uses pure price action for its confirmation, and that is the inability to make a new swing level. So when the price fails to get lower and break the swing level down here, it sets up the long trade. So we're taking advantage of the power of the buyers. And notice that all the price action is on the above the momentum indicator. The histogram's going down, you see? But that doesn't matter because we're not interested in the higher trend with this setup. We don't need it. We're only looking at swing levels failing and then trading in the opposite direction per our momentum indicator. Pretty easy. Notice that there's a setup to go short here. Why is that? Well, there's a group of dots that's lower than one group over to the left. Remember, the first red bar to close below the momentum line, either on the third dot or up to 4 bars over, could be a setup bar. So here it is on the third dot, but it's a green bar. So there's no short setup. The first bar over is a green bar. The second bar over is a green bar. The third bar over is a red bar, but guess what? It's on the wrong side of the momentum line. It closed on the momentum line. Actually, yes, it did close on the momentum line. That's not a setup. The 4th bar over, it finally closes below the momentum line. And so this is a short setup based on the dots over here. See, pretty smart calculator, isn't it? Notice there's a dot above. That tells you where your stop is, and it's at the same location as those 3 dots. Okay? We'll teach you that in a moment. But the price never comes down. You don't get the additional price confirmation to break out below the low of that bar and actually move towards the entry of the trade. Instead, the price turns around and goes the other direction. So this phenomenon, instead of getting short, it actually comes up and triggers into the long setup for a nice trade up. Okay? What cancels this short setup? Well, the main thing is if you get 2 bars that close on the other side of the signal line before the price comes down and touches the entry. So in this case, you get 1 bar closing above the signal line, you get a 2nd bar closing above the signal line, which is the bar that triggered in to the long trade. 2 bars closing on the opposite side of the setup cancels the setup. But let's say this first bar went up and got into the long trade. That would have also canceled this short trade. Okay, so another trade triggering in is going to cancel this trade as well. So those are 2 ways that that short trade can get canceled. A third way would be if you get a new short setup, then we would look at the new setup and we would then forget about the older setup. So we're always interested in the newest setup that occurs. Pretty simple rule. Now I realize you're hearing this for the first time, you're going to have to think about it and digest it, but when you see a lot of examples and you get repetition and you see it over and over and over, and you witness us in the live trade room trading this strategy with these rules, all of a sudden it's just going to become automatic for you, like a reflex, like riding a bike. Once you learn it well, and you'll never forget it. And you're going to get to that point, don't worry. All right, on the next video, I'm going to teach you our 3rd setup, and then I'm going to teach you about the trade profile itself, how we determine entries, targets, and stops. So let's get to it.